Between December 1998 and mid-2000, a single retail trader turned $10,775 into $18 million. In under 2 years, that total compounded to $42 million. Returns of that magnitude usually belong to operations housed in secure data centers. You expect to find server banks, high-frequency algorithms, and armies of quantitative analysts, specialists who use mathematical models and large datasets to identify trading opportunities. But the setup responsible for this 164,000% return belonged to a former construction worker named Dan Zanger. His equipment consisted of a standard PC and a dial-up connection. Zanger operated under a set of extreme self-imposed constraints. He applied no predictive indicators. He ignored money flow analysis and refused automated stock scanners. Curious, a single individual extracted a world record fortune from the most competitive financial environment on Earth, relying entirely on raw visual observation and analog discipline. To understand the mechanical edge of Zanger's strategy, we have to look at what he actively throws away. Standard retail trading is often clouded by visual noise. Tools like Fibonacci retracements, horizontal lines used to predict support and resistance levels, or complex moving average clusters are stripped away. This chart shows the only 3 components allowed on his screen. The methodology relies exclusively on daily price bars, which show the high and low of the day, and volume bars, which measure the total shares traded. When you remove the mathematical overlays, simple geometric shapes emerge from the price action. You begin to see clear formations, pennants, channels, and the classic cup and handle structure taking shape. A shape on a screen is meaningless without a validation tool, and that tool is volume. A pattern is only valid if massive volume spikes confirm that heavy institutional money, the massive buying power of funds and banks, is entering the stock. Zanger treats the chart as a psychological map. His entire system is built to track the specific footprints left behind when institutions move massive amounts of capital. The minimalism on the screen requires a grueling nightly routine off the screen to actually work. Every single evening, Zanger manually clicks through 400 individual stock charts. He does this to memorize the distinct personalities, the unique cadences, and the specific behavioral tics of each company. He rejects automated stock scanners because of a timing delay. By the time an algorithm successfully flags a stock as breaking out, the precise psychological entry point has already vanished. This relentless manual work ethic was forged during the severe housing downturn of the early 1990s, back when Zanger spent 20 years in the construction business. The mastery required a brutal crucible. He spent 6 years working 60-hour weeks just staring at shapes, and he lost his entire bankroll multiple times because he failed to recognize the start of macro market corrections. To generate his outsized returns, he utilized 2-to-1 margin. Margin is a loan from a broker to buy more stock than you have cash for, which amplifies both gains and losses. Operating at this speed leaves zero room for error. The visual simplicity of his trading patterns is a deception. The method functions strictly because it is underwritten by thousands of hours of early failures and an obsessive manual grind. Zanger's world record was ultimately enabled by the macro environment of the late 1990s. The dot-com and tech boom provided an era of extreme historic volatility. His pure chart strategy was perfectly tuned to capture the raw human euphoria and panic driving that specific era of the market. When a stock breaks through an upper trading band on massive volume, it represents sheer human urgency. It is the visual manifestation of institutional panic buying as large funds rush to secure a position. Today's financial landscape operates differently. It is heavily dominated by black box algorithms and artificial intelligence systems executing thousands of trades a second. Yet no algorithm has replicated 164,000% return over 18 months. Algorithms process massive datasets, but they struggle to identify the nuanced personality of a dormant stock waiting to wake up. His success required a high tolerance for repeated failure and the discipline to ignore the noise until only the raw price action remained.